How did the Canadian income tax system evolve? How did the Canadian income tax system evolve? Before Confederation, most government revenue came from customs and excise duties. As early as 1650, for example, Louis XIV of France levied export taxes of 50% and 10%, respectively, on beaver pelts and moose hides leaving his Northern American colonies. A century later, Nova Scotia imposed customs duties on sugar, bricks, lumber, and billiard tables. Excise taxes were levied on tea, coffee, and playing cards. The British North America Act gave the newly formed Canadian Parliament unlimited power of taxation. The power remained largely unused since customs and excise duties still provided for most Dominion expenses. In 1867, the new government simply increased excise duties on liquor and imposed a tax on beer, malt, cigarettes, cigars, and snuff. In 1870, existing taxes were raised and new import duties on vinegar, wheat, and grain were levied. At Confederation, provinces were given the power to impose direct taxes for provincial purposes. Over the next FIY years, the provinces taxed horses, dogs, cars, gasoline, salmon, canaries, racetracks, foxes, circuses, traveling shows, restaurants, bowling alleys, and pool rooms. British Columbia levied an income tax and a land tax. Quebec imposed corporation taxes. Ontario imposed succession duties, and Prince Edward Island levied both a property tax and an income tax. In 1914, Canada joined Britain with the war against Germany. At that time, customs and excise duties still provided 90% of total Dominion government revenue. To finance the war effort, the federal government in 1916 imposed a corporation tax known as the Business Profits War Tax. In 1917, the Income War Tax Act, described by the Borden government as a temporary measure, was introduced, much to the dismay of the provinces that had come to believe that only they, and not the federal government, had the right to impose direct taxes. Unfortunately, the end of the war did not end the need for additional revenue. Hospitals for the wounded, homes for the permanently disabled, and pensions for veterans all had to be funded. In addition, the railway that the government had acquired as a result of the war now had to be operated on a much larger scale in order to better serve the national economy. As a result, the new taxes remained in place. A decade later, in 1927, the government created the Department of National Revenue to administer the growing tax system. In 1930, only 3 provinces levied taxes on personal income. However, during the 1930s, provincial responsibilities were increased by a variety of court decisions, but no corresponding new sources of revenue were provided. The unsurprising result was that by 1939, 7 provinces imposed personal income taxes. For some taxpayers, the provincial taxes were just as high as the federal taxes, which had also risen during the decade. The Raoul-Soroy Commission was set up in 1937 to define the responsibilities of the provincial and federal governments and to reorganize the tax system. Their recommendations were still under discussion when World War II began. With the outbreak of World War II, the federal government found that its expenditures greatly exceeded its revenue. In 1941, the provinces surrendered personal and corporate income tax collection to the federal government for the duration of the war plus 1 year. In exchange, the provinces received fixed annual rental payments from the federal government. Pay-as-you-earn tax deductions began in 1942. This meant that employers withheld tax from their employees' pay and remitted it to the government. Self-employed taxpayers were required to pay their tax by installments. On January 1, 1949, the Income War Tax Act was repealed and the Income Tax Act came into effect. Since then, the Income Tax Act has undergone some major reforms and many small revisions, but its basic structure has remained intact.